Good morning, everybody. My name is Andy Barkate, and I'm the publisher of the Think to Retire newsletter. And this is our month-end webinar for the month of April 2021. Today's Friday. Markets have done well. Let's kind of get right into our program. Now, I know there's still some of you that are kind of getting into the webinar, so I've started just a couple minutes late to let everybody have a chance to get in. So if anybody gets in a little bit late, I'll mention this throughout the webinar, but you can always go back and listen to the archived version of this, which will be on the website probably sometime this afternoon, maybe tomorrow. But let me go ahead and change my screen to go ahead and get started. Okay, here we go. All right, come on. Oh, there, okay. Again, month in review. We do this every month. The purpose of this is kind of explain where we're at, why we're allocated where we are, the returns, and also to spend some time just explaining the philosophy of the whole Think to Retire newsletter, as well as adaptive investment allocation, or AIA, just so I believe the more you hear things, the more they make sense. And we're trying to make sure that you, the subscribers, get the most as you possibly can out of this service. So let's go ahead and get started. Okay. I like to make sure that everybody knows how to communicate with us. I think it's very important that you understand and feel comfortable asking questions, because after all, you're our subscribers. There's our phone number directly into the office. That is my email that shows up in my inbox, not to somebody else, but in my inbox. Our thinktoretire.com website. And again, you can go there, and a lot of you have already done this. You've requested phone calls and live demos. Every one of you have gone through a onboarding demo, so that's kind of the same process. Use that if you like to. We recommend you do that. It kind of gets one-on-one communication between us here and you, our subscribers, again, in an effort just to make sure you're getting the most out of this service. And the more you understand it, the more you can understand how to use it the best way possible for you. And again, as I mentioned a minute ago, for those of you that come in a little bit late to the webinar, missed the first part of it, you can go back and listen to it in the archives. Okay. This is what the market has done either from the beginning of this month, April 1st to April 30th. Now, again, this is a longer term chart. April is more this little point up here in the corner. I always want to show a bigger chart to kind of show you some perspective on where we're at now and where we've come from. The dip you see here is COVID, and you can see we've come a long way up. It's been kind of choppy, but it's been a pretty good ride, and so far it's continuing. This month, from April 1st to today, this morning, the market's up about 5 1/4, just a month, so it's been a really good month. And the Treasury bill rate is right around 1.63. It was a little higher last month. We had a nice run up, which caused a little of this volatility here, but it's since gotten a little bit better. Okay. Some of the market drivers today, actually this week, this month, have been some of the same ones last month, but the big push this month has been because of positive corporate earnings. We've had very good earnings. They've either met or exceeded their expectations, and that's really helped the market do well this month. We've also had some good economic reports come out, namely on jobs, and several reports came out very positive on the jobs front. We had some good GDP numbers come out just earlier this week. We also had our president come out with 2 new stimulus packages. We were kind of expecting them, and they're now out there. They're not law yet, but we have a $2.2 trillion spending package for infrastructure, and another 1.8 for what's called a American Family Plan. Now, what these are going to look like and how much money they're going to actually entail is not basically known yet. But again, it's a lot of spending, and the market likes that. Now, on the other side of that, we've got the concerns that all this new money might create inflation, which would hurt the market, drive interest rates up. And also, we've got the concern there's going to be higher taxes to help pay for all this spending. There's talk about higher corporate taxes, capital gains, and state taxes, or basically just step up in basis on a state tax, which would create a big issue there. Now, none of that's locked in yet either, but nonetheless, that's kind of the other side of the tug of war that's going on between new money coming to the market and driving the economy and stock prices and all asset values for that matter. And what's on the other side of it, which is potential taxes and higher inflation. So far in that tug of war, the new money's winning so far. Okay, where we're at right now in our current positions and how we're allocated in our sector rotation. Right now is at the end of April, we're at energy, basic materials, financials, and industrials, split 25% across the board. Here's some of the ETFs or exchange traded funds you can use that will mimic these sectors. And there's some mutual funds that are tied very tightly to these sectors. These are also on your monthly newsletter, which you would have gotten about a month ago in your inbox. It's also in the archives on the password protected side of our website. Now, the rate of return, AIA, this year to date is up about 10%, 9.9 to be precise as of this morning. The S&P 500 is up a little over 11. A lot of you think, well, why are we not beating the market? Well, if you've heard me talk before, you probably heard me say multiple times, our goal here at Think to Retire and AIA is not necessarily to beat the market. Our goal is to provide a smoother ride over the long run and bring down risk as much as we can, which is what our risk indicators are all about. And I'll get to those in a little bit. But again, I believe that if we can reduce the damage in the bad years, the up years will take care of themselves. So good markets will take care of themselves, and we'll end up with a better long-term return and a much smoother ride and a lot less sleepless nights. That's our big goal here, is to reduce volatility. Okay, now probable changes coming up in May here in a couple days. We'll have the newsletter going out on Monday morning, May 3rd. And right now, it looks like there's going to be no changes. It looks like the same 4 sectors. Again, let me go backwards to that slide. Energy, basic materials, financials, and industrials will be the same sectors showing the best relative strength going forward for the next month. So I'm anticipating right now there won't be any changes. But again, that's not gospel. So there may be something that happens over the weekend, but right now that's kind of looking like where it is. Just want to kind of give you a heads up. Okay. Now, this part of the webinar is, as I always say, is more for the newer subscribers. This is where I explain a little bit about the theory behind Think to Retire and AIA. But I think even if you've been around with us for a while, you've seen this once or twice before, it wouldn't be bad to kind of brush up on it. I think you learn something new every time you hear it. So here goes. The newsletter itself is a digitally provided tool to help you do better financially for yourself. It's geared towards the person nearing and approaching retirement to the one that's already in retirement. And we're going to provide information on a multitude of subjects. You're going to get information on the markets and economy. We're going to give you a weekly market in review email, which basically hits your inbox every Monday morning. You're going to hear a monthly webinar, which we're doing right now. And these 2 things are coming up. They're not there yet, but there's something we're working on. I just wanted to kind of give you a preview. We're trying to get a tax newsletter tied to the website just for subscribers. So again, it gives you some ideas on what's happening tax-wise, so you can basically take advantage of what's out there so you can actually do your tax planning and hopefully keep more money in your back pocket. Again, a big part of Think to Retire is about helping you save money on investment and management fees. Taxes are a big way to save money too, but you've got to actually do something. It doesn't happen by accident. And again, a Social Security maximization calculator is something we're trying to add as well. We're still working with these carriers to be able to provide them to everybody, but that'll give you some ideas on how to optimize your Social Security income, and also give you some ideas how to use some of the claiming strategies available to maximize your take from Social Security. Those are some things we're going to bring out in the future. Just as part of the site, there's no additional cost. Everybody's going to have the availability to use these when needed. And the same thing we're always doing is bringing out ongoing information on various important and financial areas such as taxes, Social Security, Medicare, estate planning. We're going to pick a couple of those every month and provide you maybe a couple of articles just to kind of keep you up to date on what's happening. And again, I just think the more you learn, the more you're going to be prepared, the better decisions you're going to make. And again, above all, the gem of our newsletter is AIA, adaptive asset allocation. Again, and to explain that, AIA is pretty much sector rotation with risk management overlaying it. It's not always good to be in the market. Sometimes it's good to sit on the sidelines and just rest it out and get out of the way of danger. The goal of AIA is to reduce your risk, reduce your volatility, make a smoother ride, and do it without giving up all the rate of returns that we want, all that long-term growth, and also save you cost. We're charging you a flat fee, as you know, and most investment advisors, which I believe there's a lot of reasons not to use an investment advisor. One is they charge too much. The other is they don't have really any well-defined volatility or risk control criteria and mechanisms. The other is the rate of returns in a lot of cases are lackluster, and you're paying a lot of money for that. So we're trying to provide the antidote for that. And again, you can watch some videos. We've got various videos on the website. Hopefully you've taken liberty to look at a few of those already. By all means, go back and look at them again. It's always good to refresh yourself. Okay. You've heard me talk about Ben Graham before, but I think if you understand a little bit about what this statement means, you'll understand a lot about the philosophy we have here at Think to Retire. The essence to investment management is the management of risk, not the management of return. As I've said before, and I've already said it once, if we can control the volatility or reduce the volatility in the bad times, the good times will take care of themselves. The markets will do well. We'll end up with a good rate of return over the long run, and we'll get there with a lot more hair still left in our head and a lot less sleepless nights. Okay. The asset allocation is a rotation that happens over an ongoing basis because markets do have personalities. They tend to favor certain sectors, certain industries, depending on what's going on in the economy. And that sector, those rotations change with the economy. So what we're trying to do is keep you in front of the sectors that are showing the highest relative strength on an ongoing basis. Every month you're going to get a new sector rotation. Sometimes there's very little change in the four sectors we show you. Sometimes there's no change at all. Sometimes it completely changed. So it depends on what the market is telling us is what we're doing. There's no guesswork going on. There's no estimates. There's no conjecture. This is all based on math. It's all based on math and actually consistency in trying to apply the principles that we're using to get you the best allocation so you have the best chance of succeeding going forward. Okay. So the other thing that I think is important to understand and to use with AIA, you ought to understand your risk tolerance. Not in a lot of cases, not all your money should be in AIA. Maybe only a portion of it should be, maybe half, 60%, 40%, whatever you feel comfortable with from a risk point of view. You probably never want all your money in the stock market. You may only want a portion of it, and that's the portion you're using AIA with. And I'll talk about that in just a second. You also want a good brokerage account. Hopefully you have one now, but if yours is a little clunky and you're not getting the help you need, putting in trades are a little bit hard, go to one of the companies where they've got a good, clean online platform. They've got good 24/7 support. So if you do have questions, you can talk to a live body. And, really having a phone app is a nice thing. I enter most of my trades on the phone. But then some of our other customers do the same thing. But you want that ability in case you're out of town during an allocation. You want to get on your phone and make the changes and go about your day. And having fee-free or no-free or commission-free trading is definitely a plus. A lot of the bigger firms have that already. And that's just going to keep more money in your back pocket. We deliver all this to you through email. So watch your emails. The alerts are sent there. The weekly market reviews are there. The webinars are actually, we'll tell you the time and date of the webinars. Are posted there on a website and on the, they're on the website, but they're given to you through the emails as well, and the monthly newsletter, which is all important, is delivered to you the first business day of each month. In this case, it's next Monday, which is May 3rd. Okay. All right. Now, I guess to go through some of the philosophy is I've always firmly believed that most investors fail to do well. Maybe they underperform, maybe they lose money, not because they're not intelligent, not because you don't have the desire. Is you don't have any, you really just don't have a good system and a good methodology to guide you. Something that's steeped in fact and math, just not what somebody said at the coffee machine or what you read in the paper this morning. You want some ongoing system that has consistency to it to guide you through the good and the bad times. And Think to Retire and AIA can be that system for you. There's basically a two-step process. First step, right off the bat, is risk management. Do we want to be in the market or do we want to be out of the market? Does the indicators and the data and the evidence and the metrics surrounding the market indicate that we should be in the market or we should be out of the market? We have two risk indicators. One is short-term, one is long-term. Both of them must be positive for us to be in the market. If either one turned negative, we back away, we send you an alert, and we back away from the market and go back to bonds or cash, or maybe a fixed account, if you have the ability to do that. Now, also, when you look at the risk indicators, what they're looking at is they're crunching numbers every single day, and they're judging and asking the question, is the current direction of the market have a high probability of continuing? In other words, if the market's going up, and I've got a slide in a minute, I'm just going to wait to get to that. Here it is. Again, they're crunching data, and if the market, let me get my cursor to work here. If the market is in an uptrend, it certainly starts to dip. They're crunching the same data points and the same metrics every single day. So if those data points start to suggest that this new trend in the market looks like it's dropping, that trend shows a high probability of continuing and continuing to fall, it's going to issue an alert to back out of the market. On the other hand, if the market's in an uptrend and it has a few bad days or a week or a couple of bad weeks, and the data doesn't suggest or not definitive that the new market direction is going to continue, it's going to keep us in the market because the market might continue to go up. We've all seen good markets have a bad couple of days or a bad couple of weeks only to continue that upward track. And we don't want to jump out of the market to be too hair triggered. That's the same on the way back up. If we're out of the market and the market starts to climb back up off the bottom, those same indicators have to tell us and prove to us that the probability of this new direction of going up looks like it is going to continue. And if that answer is yes, the indicators will go positive. We'll send you an alert suggesting to move back in the market and giving you the 4 different sectors to move into. Okay. Now, again, I just explained a lot of this, but there's basically 11 or 12 different sectors, all very different. And if we're in a positive market environment, we're going to be in the top 4 sectors, the top 4 performing sectors showing the best relative strength. It doesn't mean they're all not going up. We're trying to be in the ones that look like they're poised to gain the most and stay away from the ones that are kind of lagging. Now, if we're in a negative market environment, if one of our indicators kicks off and we go negative, we're going to back away from all the 4 indicators, get out, and go sit back in bonds or cash, just to get away from the market. The indicators and the math are suggesting we're approaching a part of volatility where the market may continue to fall. So again, I guess I got to say this every time. The system works wonderfully. It is not perfect. Just because the indicators jump and tell us to get out doesn't mean the market might not have a couple more good days before it falls, or it may even be a false read. That's happened a few times in the past too. But again, we've got a consistent system we follow, and over the long run, it's done a very good job. Okay. This is the risk questionnaire I mentioned a few minutes ago. It's good to assess one's risk. I think if you've done this already, it wouldn't be bad to do this every couple of years at least, maybe even every year. Again, this is one I did on myself. I answered all the questions, and I came up with a score of 57. My name right there. That means I'm average risk. So again, this is designed to let you understand maybe a little bit more about yourself so you know a better way to use Think to Retire and AIA. Maybe not all your money belongs in the stock market. You can use AIA any way you wish. We're just trying to give you some ideas on how you might use it to get the best results and build and be in the same risk tolerance that makes you feel comfortable. Okay, here's a couple of ways I've kind of thrown here just to give you some ideas. If you're of moderate risk, like I just mentioned I was back on the previous slide, I may want to have maybe only 60% of my money in the stock market. So I would allocate about 60% to AIA, which this portion of my portfolio would be split between those 4 sectors that we would have each month. The rest would not be in the market. It might be in bonds, it might be in cash, it might be in a fixed account. But again, I'm not going to be in the stock market with a part of my portfolio. That could be 50-50, it could be 60-40 the other way. It's what you deem appropriate. If we're in a positive market environment, a portion of the portfolio would be in the 4 sectors suggested by AIA in a monthly newsletter. If we're in a negative environment, where one of the risk indicators had ticked off and said, get out of the market, we'd go back to bonds or cash just to get out of the market and sit on the sidelines for a while. Could be days, could be months. Okay, here's another idea. Again, this is something a little bit more aggressive where you've got just a portion of your money out of the market, out of the stock market, and the rest would be all in AIA. You'd be split between, in this example, most of your money would be, in this example, 90% would be split between the 4 sectors. We're in a positive market. If we go negative, we'd bounce out. Now, you can use this any way you want. Some of our subscribers will never be completely out of the market. So if we go negative, They may not jump completely out of the market. They may keep some of the money in the market. It's up to you. It's what you feel comfortable with. Okay, let me go back here again. What I do a lot with AIA is I will have about half my portfolio in AIA, about half of it. And the other half I always keep a cash position of maybe 10 to 15, 20%. And the rest I have in individual stocks. So I use mine a little bit different. You can use it any way you want. But the AIA portion of my account, which is about 50% of it, I'm using the same 4 sectors invested at the same time you get your newsletter. So I'm doing the same thing that I'm recommending for you, and our newsletter recommends for you to look at. Okay, these are some of the returns, just to kind of go through these. Let's get this out of the way. Okay, this is the growth model where we're mostly about 90% in AIA and maybe 10% in bonds. Again, this is moderate. I'm sorry, I was a little bit ahead of myself. Moderate is about 60% in AIA, 40% in bonds. And this is against the S&P total return right here. This is all in stock. And you can see the difference. The blue is the model, the AIA model, and the dark line, the black line, the dark gray line is the stock market. And you see the model outperforms by a good margin the market itself. And again, this is not done because it's smarter than the market. It's done because we missed a lot of the downside. Let me show you that. Back here, you see the beginning of the century. This was part of the dot-com bust at 9/11. The market was down about 40% there, the S&P, as you see from the risk exposure profile. And here, this dip you see here in the market, this was because of the mortgage meltdown in 2007 and 8. That was over 50%, about 55% there. And with AIA, because the risk indicators ticked off, we missed the lion's share of that downside. Got out of the market, moved back to bonds, made a little bit of money there before we went back in the market. In this case, it was months later. As you can see by the risk profile, the risk exposure profile, this dip here, the dark area is what the stock market fell. The lighter blue area up here is the volatility that the model provides. You see much less volatility. Again, we're trying to make the ride a lot smoother. This is COVID right here, that big dip you see right there. And the model, the risk indicators ticked off and got us out of the market towards the end of the first week of COVID. So we took a little bit of a poke in the eye, as you see there, right there. But we missed the lion's share of the downside and sat it out and then jumped back in the market. It did pretty well. Just to kind of bring you up to some of the numbers, over this 20-year period from 2001 till literally the end of last year, the stock market itself was up just about 7%, 6.96. But the model, the AIA moderate model was up 12.6, quite a bit of a difference. The difference between $100,000 going to $337,000 or over $1 million, big difference. And you did it with less volatility. Now, again, it's not perfect because you even see down here the maximum drawdown, which is defined by the worst pullback that happened during that period of time. The market itself, the S&P was down 55%, this worst drawdown, and that was right in here at the first quarter of 2009. That's the worst it got, that big drawdown right there. AIA, the moderate side, it was down just about 10%, and that was right around here. Right around here, 2010. So you see, the rate of returns have been made over the long run more superior just because we missed a lot of the downside and took a lot of the risk out. That's a big part of what we're trying to do. It does a great job, but again, it's not perfect. Okay, this is something a little bit more growth oriented, where the vast majority of the money is in AIA, about 90%, 10% of it is always in bonds or cash. And again, you see something similar. We see the growth, the S&P 500 versus the AIA growth model. And something very similar, but the gains are a little bit more. Instead of 12.6, it's 14, just shy of 14.2. The same risk profile, the worst case on the S&P is 55, the worst case on AIA growth is about 12. So again, took a lot of the risk out and got a lot more return because you reduced a lot of that volatility. So again, I think the biggest thing we talk about here, we always talk about saving money, and the cost for AIA is a great deal less expensive than you'll pay with an investment company or investment advisor. And I think arguably you have much better risk control, and more than likely you'll come out with a whole lot better rate of return over the long run. So again, to go through these a little bit more in detail, always give us a call, set up a demo. We'll go through the numbers. We'll do different time frames. If you want to look what happened the last year, the last 5 years, we can run those numbers for you and just talk to you a little bit more about what AI is designed to do so you can use it the best way possible to make your finances, your investment plans, your retirement plans just a little bit more amenable to you and hopefully keep you in the game longer, because we all know that the market from time to time does not go up. What goes up must come down, and our goal is to miss the large, if not the lion's share of that downside. So again, set up phone appointments, set up demos, give us a call, send me emails, we'll communicate back with you. And I'll be back roughly in about a month. I'll probably in the next few days put on the website when the next webinar is going to be. We try to do them on Fridays. Every now and then usually it's the last Friday of the month. In a lot of cases, I'm out of town on Friday, so we might do early in the month. We'll make sure you know that on the website and by email. But until then, we're still in the market. So far, things look good. So we'll have the next newsletter out to you in a couple of days. And again, to sign off, enjoy the rest of the day. Have a great weekend. And if anything comes up, please give us a call.